Hello, this is David Hillier, and I will be giving a short video on financial markets and corporation. And this video is designed to accompany the book Fundamentals of Corporate Finance. So the overview of this lecture, I'm going to talk about financial markets, what they are, why they exist. I'll be speaking about cash flows and how cash flows through the financial system. We'll look at the ways in which different financial markets operate, and we'll talk about that from a kind of conceptual level. And then we'll just do an example right at the very end on Google and bring all the different aspects of finance together into one small, brief case study about the lifetime of a corporation, in this case Google. So our learning objectives really to understand why the financial markets exist and what they do. Financial markets were originally designed to bring companies that needed or individuals that needed cash into contact with companies or individuals that had excess cash, so that there could be a transfer of that cash from one party to the next. Financial markets have existed for thousands of years, and it's really only over the last, 400 years that we've had a much more formal approach to the financial markets. Cash flow underlies everything in finance. Companies need cash to run their business. They get their cash from investors. Investors expect a return from their investment, and governments need the cash through the form of taxes. Now, if you look at this particular slide, and this is figure 1.2, you can start from anywhere, but let's start off from the point A. A manager needs money to invest in a new project. That project could be simply repairing a roof, or it could be buying an asset. It could be a number of things, but they need cash. Where do they get the cash from? Well, if they've not got cash in the company, then they need to go outside the company and get external financing. So they go to the financial markets. They may decide to invest, or may decide to raise the money via debt, and we call that liabilities. It may be short-term debt, so it would be a current liability, or maybe long-term debt, which we call non-current liability. Or they may decide to give up a portion of ownership in the company, and we call that equity. Now, the cash that is provided from the financial markets, you might ask, well, okay, where does that come from? And I'm going to part G and H here. Originally, the very source point of where the cash comes from is ultimately households. Households put money into bank accounts, they put money into pensions, they put money into insurance products, and these products are, collated by and aggregated by the financial institutions to invest and get a return for the financial institutions. That's where the money comes from. But the cash will go into the company, and the manager will invest that cash in an asset, and that's part B on the left-hand side. They may invest the cash in short-term assets, and we call that current assets. Or they may invest the cash in long-term assets, which we call non-current assets. What happens to these assets? Well, these assets will generate cash, and they will bring in money to the company. That's how you increase value in a firm. And the company can do three things with this cash. They can reinvest it in their own company in more assets. They can give out some of that money in the form of dividends to shareholders, or they would pay the coupon, which is the interest on debt. And a part of it they will have to pay the government in the form of taxes. So what we see cash flowing through the system. Cash is the most important thing. In terms of making decisions, you use cash to pay people you generate cash. You don't generate, in a sense, you can't pay people with earnings, accounting figures. You can't do that. It's cash that you deal with, and in finance we focus on cash. So, talked about cash. Now I'm going to talk about the markets, and this is a terminology slide. You have primary markets and you have secondary markets. The primary market is the market where what you see is the source, not the source, the money goes to the primary objective of the investment. So if a company was to go to the markets to raise money, and the money that was raised went to the company, we would say that was a primary market transaction, because the money that was raised and the money that was transferred went to the operations that would generate value and generate the return. And we have another few kind of sub-terminologies, but they're very common. When a company does this for the first time, we call it an initial public offering, and public means it's been sold to the public investors for the first time. A company can go back again, like if at some point in the future, 9 months down the line, that the company needs more cash, they would go to the markets again and maybe get another equity issue. It might have the equity issue might have the exact same characteristics as the first, or it might not. But we would call that a seasoned offering. So, but the primary thing, or the key thing for this, is that money goes to the firm where the operations are generating value. Now, if you're an investor and you've purchased equity or you've purchased debt, and you decide to sell it, or you might decide to buy equity and buy debt, you would buy it off another investor. So the money that was transferred would not go to the company, it goes to the investor. And we call that a secondary market transaction. And that's where you get share prices. The share price in a stock exchange comes from the trading of investors in a particular security. And that is a secondary market transaction. And sometimes it can get a bit confusing. So, for example, if you're a very large investor, say you own 60% of a company, and you decide to sell the shares of that company, the equity of that company, you could have a big offering. It's 60% of the outstanding equity of the company. But the money that's raised won't go to the company. It goes to you because you're selling the equity. And that would be a secondary market transaction that looks like a primary market transaction. The next thing I want to talk about, and again, we're just covering some of the key concepts in finance in this first chapter, is how do financial markets work. There are two main ways in which they work, and one's a dealer market and the other's an agency market. Dealer market, I would like you to think about a car dealer. You sell your car to a dealer, the dealer buys it from you, and the dealer sells the car on for a profit. The money that the dealer makes is the profit. It's the spread between the price that the dealer asked for and the price that the dealer bought for, and we call that the bid-ask spread. So if you look at this example within the context of financial markets, you would sell a financial asset to a dealer for £100 and the dealer sells it on for £110, so it gets a profit of £10. Dealer markets you would see in, for example, foreign exchange, trading of foreign exchange, and also some equity markets, some debt markets. An agency market is slightly different, and I would like you to consider an estate agent. You don't sell your house every day. You sell it very rarely. And you have no real knowledge, you have no real infrastructure in terms of being able to sell your house in the market. So what you do is you hire an agent. That agent will then go out and try and find a buyer for your house. And how do they do that? They put up adverts and they put it into the trade publications. They might even have an office. They may have a website. The agent doesn't own the house. What the agent does is tries to get the best price possible and then takes a commission on that price. And if you transfer that to the financial markets, then you might want to sell the equity of your own company, or you might want to sell debt of your own company, and that is to find buyers of the debt, and that is investors or lenders, or find buyers of the equity, which is they become shareholders. And in this case, the agent sells for 110, and then the agent gets commission of £10. So the agent at no point in this owned the asset, and in the dealer market they do own the asset. So that's the difference between the two. An agency market predominantly occurs when companies want to sell their financial securities to the market, and they hire an investment bank to do that. And I will cover that in a later chapter in the book. So where are these equities and debt instruments traded? They're traded on stock exchanges. And examples of stock exchanges are, you've got the New York Stock Exchange, that's in the US, London Stock Exchange, Euronext. Euronext is a grouping of several continental European stock exchanges. Paris, Amsterdam, Brussels and Lisbon. You have stock exchanges all over the world, so you have the one I'm showing here is Shanghai Stock Exchange, and then you've got one in Japan, it's the Tokyo Stock Exchange. Every country will have a stock exchange, and so it gives an outlet for companies to raise money. Some stock exchanges are more advanced and developed than others. The New York Stock Exchange is massive. It's trading all the time, and the London Stock Exchange is similarly massive. And in actual fact, if you rate exchanges total values as a fraction of a country's GDP, then London Stock Exchange is the largest in the world. So I've given a very quick whistle-stop tour of different aspects of corporate finance. These are all covered in section 1.3 of the textbook. And now I'm just going to give a very quick overview of a lifetime of a company and how different aspects of finance come in. So Google, set up by two individuals, Sergey Brin and Larry Page, had a great idea for a search engine. They needed funding for it, so they had to go around trying to get funding. Eventually they got funding, and they got equity funding. They could have got debt funding, but they got equity funding, and we cover financing in a couple of chapters later on in the textbook. They grew and they grew and they grew, and then they decided that in actual fact they needed a lot more money to be able to expand overseas into China, into different parts of the world. So what was their best approach? Would they have brought out or taken out a big debt instrument, or would they give up ownership of the company? And what they did is they gave up ownership of the company, and they listed on the stock market. Now if we look at Google, we've got a multinational company. They've got different classes of shares. They're making investments all the time. They're buying companies, so they have to use investment appraisal methods. They've got to manage their equity mix with debt. It'll be short-term debt. As far as I'm aware, they don't have a lot of long-term debt, and they have to make sure that they've got enough cash. And what we've got here in corporate finance, spans from the idea and valuing a company, valuing a concept, all the way through to how do you actually operate that company, and how do you run that company, and how do you maximise the value of the assets. I'll be covering all of this over the chapters of Fundamentals of Corporate Finance, and I will be discussing this in each of the different videos and discussing different aspects of that. So, very quick overview. As I've said, this ends the videos for the first chapter. I hope you enjoyed it, and I'll carry on into the second chapter on corporate governance. Thank you very much.